Oil does not speak, but it decides. For decades, a quiet alignment shaped the global economy more than most public treaties ever could. It wasn't announced with spectacle, it wasn't debated openly, it simply structured how the world priced energy. In the 1970s, after monetary instability and oil shocks shook global markets, the United States and Saudi Arabia deepened strategic ties. The logic was simple: oil would be priced and traded in US dollars. In return, security cooperation expanded. That arrangement did more than stabilize supply, it anchored the dollar. When oil, the world's most traded commodity, is priced in dollars, nations must hold dollars. Central banks accumulate them. Trade surpluses recycle into US financial markets. Liquidity deepens. Borrowing costs remain comparatively low. This pattern became known as the petrodollar system, not a rigid treaty, but a reinforced habit that evolved into financial infrastructure, and infrastructure defines influence. For years, Saudi Arabia played a central role in sustaining that structure. As one of the largest oil exporters and a key voice within OPEC, its pricing conventions carried systemic weight, but global systems do not remain static. In recent years, subtle recalibrations have emerged. Saudi Arabia has diversified diplomatic relationships. Economic engagement with China has expanded. Discussions around settling portions of energy trade in non-dollar currencies have moved from theory to negotiation. None of this signals an abrupt break, yet direction matters. China is now one of Saudi Arabia's largest oil customers. Beijing has steadily promoted broader international use of its currency in trade settlements. Energy transactions provide a strategic pathway. If Saudi Arabia were to price even a fraction of its oil exports in alternative currencies, particularly for major Asian buyers, the symbolic impact would be significant. Because the petrodollar system relies less on enforcement and more on continuity, the dollar's dominance in energy trade reinforces its dominance in reserves. Once alternatives enter the system, even incrementally, incentives begin to shift. For Riyadh, diversification offers leverage, strategic flexibility in a multipolar world, expanded investment partnerships, reduced dependence on any single economic power. But this is not a binary realignment. The dollar remains deeply embedded in global finance. U.S. Treasury markets offer unmatched liquidity. Military and intelligence ties between Washington and Riyadh remain substantial. A sudden rupture would introduce risk for all sides, so the more plausible path is gradualism. Selective contracts denominated in alternative currencies, expanded bilateral trade frameworks, public language emphasizing resilience and multipolar cooperation. The immediate effect would not be the collapse of dollar dominance. It would be dilution. Reserve currencies derive strength from network effects. The more widely they are used, the more efficient and trusted they become. If even a modest share of oil trade shifts away from the dollar, that network effect begins to soften. Other exporters may experiment with similar structures, importers may diversify settlement mechanisms, central banks may adjust reserve compositions over time. The dollar would not disappear, but exclusivity could fade, and exclusivity is closely tied to leverage, the ability to impose financial sanctions, influence liquidity conditions, and finance deficits at scale depends partly on the dollar's central role in commodity trade. If that role becomes shared, influence becomes shared. History suggests dominant currencies rarely collapse abruptly. The British pound did not vanish overnight as the world's reserve currency. Its influence receded gradually as economic gravity shifted. Monetary transitions tend to unfold slowly, until tipping points compress timelines. The deeper question is whether Saudi Arabia's evolving strategy represents tactical hedging or structural repositioning. Energy markets are not purely commercial, they are strategic. If Riyadh strengthens integration with emerging economic powers while maintaining Western partnerships, it positions itself as a balancing actor rather than a fixed pillar within one bloc. That positioning alone alters dynamics, because the strength of the dollar has always rested on alliances as much as markets. If key partners begin exploring parallel systems, even cautiously, the signal extends beyond currency markets. It reflects shifting alignment in a changing global order. There may be no dramatic announcement, no formal declaration of a new monetary era. More likely, there are quiet negotiations. Long-term contracts structured with optionality. Strategic investments designed to hedge against concentration risk. The global economy is moving toward multipolarity in trade, technology, and geopolitics. Currencies tend to follow power distribution. If trade flows fragment into regional clusters, energy pricing mechanisms may gradually reflect that fragmentation. The dollar could remain dominant for years, but dominance and permanence are not identical. Watch settlement currencies in major oil agreements. Watch cross-border payment infrastructure development. Watch central bank reserve allocation trends. Watch how leaders frame diversification as risk management or as strategic evolution. These are structural indicators. Saudi Arabia does not need to end dollar rule to influence its trajectory. It only needs to expand viable alternatives. Because once alternatives become operational, inevitability dissolves. The central issue is not whether the dollar collapses tomorrow. It is whether its foundation, energy settlement primacy, is broadening, and if that foundation widens, leverage redistributes gradually. Global finance rarely shifts through confrontation, it shifts through adaptation, quiet, strategic, incremental, until one day, the architecture looks different, and no single event explains the transformation. So consider the broader pattern. Are we witnessing symbolic diplomacy, or early-stage monetary recalibration? Is diversification a temporary hedge, or a structural hedge against long-term uncertainty? If the currency underpinning global oil trade becomes less singular, what does that imply for the balance of power built over decades? The most consequential transformations often begin as options. Options become habits, habits become systems, and systems, once altered, redefine influence. The real question is not whether there is a dramatic secret deal, it is whether the global energy market is slowly becoming currency flexible. If so, the implications extend beyond oil, into reserves, borrowing costs, trade leverage, and geopolitical influence. When the foundation of energy pricing evolves, even subtly, the ripple effects are systemic. The dollar may remain central, but centrality, once shared, is never the same, and if the process has already begun, the most important shift may not be the announcement. It may be the normalization of alternatives, and the gradual redistribution of monetary power that follows.